Live from New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, recession fears dragging bond yields lower as the ECB hikes rates into weakness. The Fed is ready to go once again. We begin with the big issue. It's over to you, Chairman Powell.
Chairman Powell.
Chair Powell.
Federal Reserve Chairman Powell.
We have the Fed meeting next week.
The Fed clearly has to fight inflation.
The Fed is going to, in rhetoric and in reality, stay right on top of this.
Jerome Powell has made that very clear.
This theme of front-loading.
It's kind of locked in.
The Fed, the Bank of Canada, the RBNZ, a lot of central banks are front-loading their rate hikes.
The 75 basis point hike is more than priced.
We're not expecting big forward guidance from the Fed.
Look, I mean, the Fed's in a difficult spot because some of this is messaging.
The Fed is very keenly aware of that.
Great panel to wrap up the week. Joining us now is Blackrock's Marilyn Watson, PGIM's Mike Collins and George Bory of Allspring Global Investors. Marilyn, I want to come straight to you. The weaker data that we saw this morning on the PMIs out of Europe and specifically here in the United States, is that part of the Fed's grand plan?
So I think the Fed, like all of us, has been seeing that data has been weakening really in several different places. So in the US, when you look at some of the underlying data in terms of the labor market, when you look at, I say the PMI data, when you look at the investment, when you look at the new orders, and particularly when you look at the services, I do think that's a particular negative because we were expecting that's one area with the reopening after COVID and as the economy, I think, shifts from people's behaviours as they start to travel more and they're doing more. I think we were expecting services to be, a bit more of a support. So it is a definitely negative. That being said, I don't think that will stop the Fed from probably moving by 75 basis points next week. Inflation remains incredibly high in the US, and I think they're going to remain aggressive next week. They'll also hike in September. After that, I do think there'll be a lot more data dependent and it will be more gradual, but certainly they're starting to factor in, as are all of the central banks, the fact that inflation is incredibly high, but data is weakening really in many, many different areas.
Mike Collins, do you agree with all of that?
Yeah, Jonathan, I mean, we're in effectively in a global recession now, right? The question is how deep is it? And I think, and I've been in this camp for a while, it's going to be a mild recession, growth in the U.S., could average zero for the next year and a half. I think that's kind of baked in, right? When the Fed starts hiking rates, they have these milestones they want to hit. The first is tightening financial conditions. You can check the box. The next one is demand coming down. That is happening really fast. Maybe it's surprising them a little bit. Not so surprising to me. On the services side, to Marilyn's point, I mean, things are just too damn expensive. Yeah, everybody and their mother is traveling all around the world this year, and they're going to come back and say, oh, my God, that was expensive. And what a pain it was to travel, right? So I think even this big boom in services is a little bit of a flash in the pan. And then, they ultimately want to see weakness in the labor market, and they want to see inflation come down. Those are the two that haven't happened yet, but I think that is imminent.
So, Mike, I've asked you this a few times. Let's go there. High of the year, 350 on 10s, just short of that. We're back down to 276. Is that it? Is that done? Is that the high baked in for 2022?
Yeah, we've seen the high on the year. We've probably seen the high on the cycle. Just a few days ago, the markets were pricing in a terminal funds rate of 3.5. And that's kind of where the 10-year got to. And I've been taking the under on that something will probably stop them from getting to that 3.5. That's increasingly looking like the case. But yeah, I think we've seen the peak in rates.
George Bory, I'd love your response to that. The higher the cycle, the higher the year, 350, that's it, it's done.
I think it's premature to say it's done. I think the reality is the Fed's been fixated on inflation, and there's very little to provide air cover for them to meaningfully change their trajectory at this point. The market is trying to look forward. The market's trying to tell us that we're getting closer to the end of the cycle than we are to the beginning, but they need some validation. We need some inflation validation. There's a little bit of glimmer of hope, and that core has kind of come off the highs. But as we know, headline's still pretty strong. And so from that perspective, the Fed has to look through the growth data at this point, unless they want to pivot their position. And they've given virtually no indication that they're willing to do that yet. So from our perspective, inflation is still the most significant challenge in the market. The Fed is hell-bent, as are other central banks, to address inflation. And they have very little choice but to continue tightening into what's effectively a slowing economy.
So, George, what do you make of the easing of financial conditions we've seen over the last couple of weeks?
So we kind of view it as a bit of a bear market rally in the sense that, positioning clearly got very one-sided, very bearish. We saw that through various surveys and other, anecdotal comments. And so there's a bit of a risk covering. Some of the acute risk is starting to get sort of taken off the table. Gas supplies in Europe starting to reignite, but still very contested. And as I mentioned, investors seem to be looking towards the end of the rate tightening cycle at this point and hoping that we get there. And so that's sort of where the market's moving towards.
Yep.
There needs to be some validation. And like we saw back in May, we may not get the inflation validation we're looking for, which could put us right back to where we started.
So forward guidance is dead at the ECB. Arguably, it's dead at the Federal Reserve as well. Marilyn, you walked us through that 75 basis point call for July. Most people on board with that, unless, of course, we get a nice little Wall Street Journal article on Monday morning that says otherwise. But Marilyn, let's go with 75. What does that mean for September?
So I think at the moment what we've been seeing in terms of market pricing and the data and also Fed speak itself is I think for September we still expect to see a hike, probably in our view around 50 basis points. And then we think from then the Fed will be much, much more data dependent and potentially very gradual. I think the next few months are really actually very pivotal when we do look at the data, when we look at industrial production, when we look at data coming through from the labour market, when we look at a range of different factors, as we do start to see how the growth and economic activity continues to evolve. And as the Fed is at the moment really just focusing on inflation. That's its number one goal right now. But I do think, going beyond September, we do expect that 50 basis point hike. And then going beyond that, I think the Fed is going to be much more nuanced in terms of the impact of the tightening that we're seeing coming through from the Fed and also the activity that we're seeing in the economy overall, as we are starting to see it soften in several different areas.
Mike Collins, do you agree with that?
Yeah, I think the Fed is going to keep hiking, right? I mean, I totally agree with Marilyn and George there. And you're supposed to probably sell into these risk asset rallies. We've been doing that generally this year. You look at, credit spreads, they keep hitting higher lows and wider wides. And you've had 3 big snapbacks in spreads so far this year. And we've generally been sellers into that. And you've just had one, right? High yield spreads are 100 tighter. Corporate spreads have snapped in here. But to George's point, people are bearish and negatively positioned. So you have to be pretty quick to buy on the wides too. The Fed is going to get that funds rate easily, probably to 3. It'll be interesting to see if they can do those last few hikes and get it up to that 3.5 or 3 3/4 where they want it. But it's all, again, contingent upon those last 2 milestones, the unemployment rate, and the wages associated with that. And I think the Phillips curve is kind of going to take another nap here. And you're not seeing those wages kind of continue to go up. And you're seeing weakness on the margin in the labor market, right? So I think the inflation story, it's all about that. That is, if it's a one-factor world, that factor is inflation. And if you told me inflation in a year from now is going to be 2 or 8, I mean, that changes everything. That changes the game totally. So I don't know what it's going to be. My guess, it's going to be cut in half over the next 6 to 12 months.
Mike, a simpler way of asking what you're trying to answer is basically how much weakness do we need to tolerate, do we need to see to get inflation down? I just had a question across the terminal on the Bloomberg by a subscriber who basically wanted to question this mild camp, this new consensus view around a mild recession. And here's the question for you, Mike. Help me answer it. Is that enough to bring down inflation? Is this going to look like the 90s course correction followed by renewed hikes again? What do you make of that?
Yeah, I think a mild recession is in the cards. I think there's a modest, maybe, 20% probability that it's worse than that. And what we're really focused on is what could be those dominoes around the world that start to fall to feed into the U.S. having a deeper recession, because I don't think it's going to be a U.S. originated problem, right? We just don't have the leverage in the system. We're not overextended, overinvested, overbuilt necessarily. So that's why we kind of have a pretty high probability of that mild base case. But there are a lot of dominoes out there in the world that are starting to come down in the developing world, in Europe and in China. So that's really the risk, I think. I actually think inflation is going to fall on its own weight, right? To Marilyn's point, I mean, services demand is coming down because people can't afford it, right? I mean, demand comes down and prices come down, or they both come down. I think they're pretty highly correlated.
George, I throw that at you. Is a mild recession sufficient to bring down inflation, or in Mike Collins' world, is high inflation enough to bring down high inflation?
Yeah, I think that a mild recession is enough, but it is enough to start to take the sting out of inflation. But does it come down enough? And really, that's the question: is sort of how quickly can inflation come down? Now, in sort of a basic economic model, slower growth should lead to lower inflation, but it will take a long period of time to get there. And the question is how long will the Fed sort of tolerate that? If we're moving down very, very slowly, pointing in the right direction, is the Fed willing to be behind the curve at this point? And the chances are that they would be, but with each incremental hike, the probability of a harder landing goes up. The other big consideration, as we've seen throughout this cycle, is the synchronization. And as we just mentioned, there is weakness sort of around the world, and that is starting to manifest itself. But the question is could we sort of experience a mild global recession? Now, that is a distinct possibility, which is different than, say, just a U.S. recession, which is in, sort of isolation, and we have offsetting factors. We have not dealt with the chances of a true global recession in a very long period of time. All central bankers are fighting inflation at the same time. They're a little late to the game, and they're leaning in with increasing intensity. So the probability of that recession is going up. It's become a very bond-friendly world from that perspective. So I feel good about it as a bond investor. But from a growth perspective, it's very difficult to see, sort of any meaningful accelerator coming in to sort of save the day. And that probability of a global recession is going up and not down.
We've got to talk about Europe too. We're going to do that in a moment. George Bory, Mike Collins, Marilyn Watson sticking with us. Coming up, the auction block. America's biggest banks leading the charge in primary markets this week. That conversation and a breakdown of the ECB up next. Jonathan Ferro, this is Bloomberg Real Yield. It's time now for the auction block, where we kick things off right here in the United States with investment-grade bond sales soaring past estimates this week. 4 of the country's biggest banks issuing debt and boosting sales above $45 billion. A different story in high yield, with the primary market remaining subdued. Just one issuer coming to market ahead of next week's Fed decision, and a second consecutive session without an offering in Europe, taking the tally of 0 days to 27 this year, already surpassing last year's total. Want to stay on Europe? Here's a question for you. Is Europe investable? Take a listen to this.
You've got to be real careful there. Growth clearly slowing, earnings estimates are rolling over. We think getting very defensive in Europe, owning quality, embracing areas like utilities, infrastructure, healthcare, staying away, because from an index construction standpoint, if you own Europe, you own cyclicality, you own economic sensitivity, not what you want to own in a recession.
It's hard to find people who want to own Europe right now. Marilyn Watson, is Europe investable?
So it is investable, but with a great degree of caution. So I certainly agree with the points made there that the data coming out of Europe is very weak. Much of it is pointing to recession. I think that when you look at what the market is pricing in terms of rate hikes from the ECB, when you look at negative impact of the very high energy prices, there's still the ongoing issues with Ukraine. I think commodity prices, food prices, production is slowing down. We're seeing some very negative data in terms of the PMIs. So I think overall the data is pretty weak, and it is certainly flashing quite a few warnings. That being said, We have seen a significant improvement in valuations in the Eurozone, but I think it really pays at this moment to be very, very careful and to really invest on a very much fundamental bottom-up perspective.
There are red lights flashing all over the place when it comes to Europe, George. I just wonder for you, we've spent a lot of time talking about Fed hikes. How small is the window for the ECB to hike interest rates with? Do we get another one? I know they've dropped forward guidance, but it just feels like that window is getting smaller and smaller and smaller.
It's smaller, but it's still open. And I think the reality is, there's still meaningful inflation pressures. But as Marilyn just mentioned, the data looks pretty weak and the economic backdrop is very much challenged. The upside here is that, as she mentioned, valuations have come a long way and continue to sort of to be relatively soft. And so from that perspective, like we've seen in different markets around the world, you get an economic shock, you get a dose of reality, and then the market quickly reprices. And that's certainly where Europe sits today. So when we look at kind of credit spreads and the spread differentials between, say, Europe and the U.S., Europe is starting to represent some pretty good value. But you do need to be highly selective. And as we've seen this week, with the ECB dropping forward guidance, a surprise 50 basis point rate hike means there's a lot less maneuverability there from the ECB's perspective, and so the economic consequences are very real and very, very challenging. So I wouldn't say with sort of a full sort of full-hearted kind of, hey, this is really cheap kind of trade, but there's some selective opportunities, but they are kind of few and far between.
Mike, Europe's tough from my perspective because Europe, I think, right now is totally unforecastable. It's not just because the ECB has dropped forward guidance. It's because I don't understand the ECB's reaction function. Even if you tell me exactly how the data comes in, what happens with gas, I can't tell you how the ECB is going to respond to it. Mike, do you share that view? Do you have an understanding of the reaction function of the ECB? And if you do, let me throw this question at you. How would they respond if Russian gas shut off? Would they hike rates or would they cut them?
Yeah, I mean, I think the ECB has kind of tipped their hand a little bit to be a little more focused on supporting the countries in the Eurozone from a fiscal standpoint and from a growth and from a monetary policy standpoint. So I think they're more inclined. I mean, if you think we have stagflation in the US, right, higher inflation and lower growth, in Europe, it's like 3 times that, right? They are really hit with this double whammy of high prices and weak growth. And I think ultimately, and I think the Fed follows suit, ultimately the central banks blink when you go into kind of a deep recession, defaults start picking up, and people and businesses, and in Europe's case, countries, really start feeling pain on the ground. I think that's when central banks say, all right, we have to support our people.
Do you think a country without a government would be eligible for that TPI program? Do you think it would be, Mike?
Oh my gosh, yeah. I don't know, John.
Isn't that the trillion-dollar question? Ultimately, Mike, if you're going to buy the periphery, don't you need a decent understanding of what the backstop is? And ultimately, the most efficient backstop is the one that doesn't need to be activated, but it might have to be. Do you have a decent understanding of that?
Yeah, not really, but I think that backstop will be there. I think we've seen too many political changes in Italy to worry about the actions on the ground today. I remember I was a sovereign Italian analyst 25 years ago, and I was worried about them then because of political risk and fiscal problems, and they're going to be around for another 25 years, Jonathan. So, and I think the ECB is going to be there to support them.
So, is there a buying opportunity on the periphery right now, Mike?
Yeah,
We had a big move today.
Yeah, they have snapped in today. But yeah, I think at those wider levels of spreads, whether it's 250, on Italy or in the 3s or 4s on Greece, I think those are buys and long-term holds here.
George, would you go with that?
I certainly agree with Mike. I mean, the ECB has effectively tipped its hand. And while the terminology is quite vague and it makes it difficult to sort of predict with certainty exactly what they're going to do, they are going to support the periphery. And that was clear several years ago. It's clear today. Now, sort of the parameters or sort of the range at which they intervene is not clear. But if the financial markets, in particular, an individual country's funding ability is stressed, it seems clear to us that the ECB has proven before and will prove again that they're willing to support the country's ability to fund themselves. And so from that perspective, when we get out to these wides, that typically is a pretty good buying opportunity.
Marilyn, I've got 2 people who sound a little bit interested in buying the periphery. Would you be buying with them or selling to them?
So at the moment, we do have small allocations to some of the periphery. In particular, we have a small overweight to Spain. So the answer to that is yes. But on the other side of that, then we're also short duration Germany. So we also have some RV trades there too. But overall, yes, we do like areas of the periphery. Again, as I mentioned, it's very much on a fundamental basis as well as valuations. And I think to your point about the ECB and what it is prepared to do, I think it was very clear yesterday that they put the PEP front and center, still being it's sort of backstop, most flexible tool that it will use. But then the new anti-fragmentation tool that it sort of unveiled, as you mentioned, is still somewhat unclear. But the fact that they suggest that it's going to be unlimited in scale and also permanent, I think is a positive sign that they are willing to do as much as they possibly can to really support all of the economies within the Eurozone.
Somewhat unclear is the polite way of putting it after that news conference. Marilyn Watson, Michael Collins, George Bory sticking with us. Monster move lower in Italian yields today, and Germany too, down 26 basis points at the front end. Coming up on the programme, the final spread the week ahead, featuring a big rate decision and a Chairman Powell news conference. That's next. This is Bloomberg. I'm Jonathan Ferro. This is Bloomberg Real Yield. Here's the final spread the week ahead. Coming up, a big week of tech earnings on deck. You'll hear from Alphabet, Microsoft, Apple and Amazon all on the agenda. Plus, more economic data, including new US home sales, US GDP and Michigan's Consumer Sentiment Survey. And finally, the main event coming on Wednesday, a Fed rate decision and Chairman Powell news conference. Tough day today. Yields lower, stocks lower, data bad on both sides of the Atlantic. Let's get to the rapid fire round. 3 quick questions, 3 quick answers, and we can go first of all to this. Is this the Fed's last 75 basis point hike of this cycle? Yes or no? Mike Collins.
Yes.
Marilyn.
Yes.
George Bory.
No.
There we go. High on the year for the 10-year is 350, just short of that. Have we seen the high of the year on the 10-year yield? Yes or no? George.
Yes.
Marilyn.
Yes.
Michael, I know the answer, but just tell me anyway for those that missed it.
Yeah, absolutely.
Let's get to the final one. Wides of the year on high yield, 580. Have we seen the wides of the year, yes or no? Mike Collins.
Yeah, I would say no.
Marilyn.
No.
George Bory.
No, not yet.
There we go. To the three of you, thank you. George Bory, Mike Collins, Marilyn Watson. You guys enjoy your weekend, and you at home as well. From New York City, that does it for us. We'll see you same time, same place next week. This was Bloomberg Real Yield. This is Bloomberg TV.